Hey, it's Josh, and today on the Infographic Show, we're asking what would happen if everyone tried to pull their money out of the bank tomorrow. On a normal day, banks look boring. People swipe their cards, they pay their bills, get direct deposits, and maybe stop by a branch to grab a little cash. But behind the scenes, it's a lot different. Your bank is moving money digitally between accounts, approving loans, and investing deposits to earn a return. Here's the important part most people don't realize. Your money isn't just sitting in a vault. Banks only keep a small fraction of deposits as physical cash. The rest is loaned out for mortgages, car payments, business investments, and government bonds. That system works because on a regular day, only a tiny number of people want their money at once. So basically, at a bank, everything runs on trust. Trust that your paycheck clears. Trust that the ATM works. Trust that when you need your money, it'll be there. But all it takes is one headline, one rumor, or one unexpected shock to flip that trust upside down. And when that happens, the calm, the everyday routine, collides with something much more dangerous. Something that could lead to some people losing everything. A bank run doesn't start with chaos, it starts with something small going wrong behind the scenes. As long as customers believe their money is safe, daily life continues as normal. But when that confidence takes an even small hit, unease begins to spread. And that trigger could be almost anything. It could start with a sudden stock market crash and reports of mounting bank losses, or with rising interest rates that erode the value of long-term investments. A major business customer might pull out a massive deposit, or an earnings report could reveal a bank struggling to balance what it owes depositors against money tied up in loans and bonds. And that is when the clock starts ticking. Remember, banks don't keep most of your money as cash. They lend it out or invest it, so if the value of those assets falls, or too many deposits leave at once, the bank's cushion begins to shrink. On paper, the bank still holds its assets and maintains its balance sheet, but it has far less room for error. In some situations, the problem is simply speed. A modern bank can lose billions of dollars in a matter of hours, especially when large corporate clients move money digitally and without warning. If a bank can't sell investments quickly enough without taking major losses, its financial position weakens. Nothing has exploded yet, and there's still a chance that the bank could meet its obligations. ATMs still work, transfers still go through, but behind the scenes, regulators, executives, and investors are watching very closely. And what happens next will determine whether the bank survives or collapses entirely. And out in the real world, customers might begin to sense something's off. There's no full-blown panic yet, just discomfort. A feeling that the system isn't as solid as it looked yesterday. That unease is the spark. And what happens next causes that spark to turn into an inferno. This is the moment everything changes. Up until now, people just felt uneasy. But once a bank actually looks like it might be in trouble, fear takes over. Customers stop asking questions and start taking action. They log into apps, they visit branches, and they hit ATMs. Not because they need the cash, but because they don't want to be the last person left when the money runs out. Banks are built for normal days. Maybe they can handle slightly busy days, but they're not built for stampedes. Every institution carefully plans how much cash it needs for daily withdrawals. The Treasury system works when behavior is predictable. But when more people than expected start pulling their money out, those reserves start to get strained fast. The further withdrawals go beyond what the bank planned for, the higher the risk becomes. And customers can sense that. A few missing features in an app, a slower wire transfer, a longer line at the branch. Each small delay feels like proof that something is wrong. And here is where things start to spiral. A bank run happens when large numbers of people withdraw their money from a financial institution in a short period of time. As withdrawals grow, the bank starts to look weaker to everyone who still has money there. And as the bank looks weaker, even more people rush to pull their funds. Fear feeds fear. One person's just in case becomes another person's emergency. The situation snowballs until the bank simply can't keep up. Too many people want cash at once, and the money just isn't liquid enough to move that fast. The money locked up in mortgages, business loans, and government bonds takes too long to convert to cash. So to meet demand, banks are forced to sell assets as quickly as possible. And selling fast means selling cheap. Loans get abruptly called in. Bonds are dumped at rock-bottom prices. Every rushed sale weakens the bank even more, making customers even more nervous. History shows how violent that feedback loop can become. During the Great Depression, the stock market crash made people doubt the financial system. Depositors rushed to pull out money, forcing banks to liquidate assets just to survive. News of one bank run triggered another and another and another. The panic spread faster than any regulation could contain. In 1930, one rumor alone helped sink the Bank of the United States. After a customer walked out angry and spread talk of insolvency, crowds formed within hours. By the end of the day, millions in cash were gone, not because the bank failed first, but because fear did the damage before the truth could catch up. But modern banking moves even faster. In 2023, Silicon Valley Bank saw about $42 billion leave in a single day as corporate customers transferred money digitally. No lines, no shouting, just a few simple clicks. The withdrawals overwhelmed the bank's ability to sell assets or raise capital fast enough to pay out its customers. And to customers, that feels terrifying. If you're told that you can't get your money, your first thought isn't relief, it's, what are they hiding? And that thought pours gasoline on the fire. At this stage, the run is no longer controlled. Every withdrawal makes the next one more urgent. Every headline brings more customers demanding their money. And the worst part, this is only the beginning. Once panic hits the banks, the damage doesn't stay inside the walls. It starts to spill out into the entire economy. That's when mitigation measures kick in. Emergency tactics designed to slow the run, restore confidence, and keep the institution from failing outright are launched. Some of these moves are subtle, others are dramatic, and all of them are about buying time. First, the banks try to slow everything down. In the past, banks literally slowed people in line. During U.S. recessions, employees and even their relatives would stand in front of tellers making tiny deposits and withdrawals just to clog up the system and delay the rush until closing time. Today, the same idea exists digitally. Transfers suddenly take longer, apps show technical issues, wires get delayed, limits are placed on how much you can move in a day. None of this fixes the problem, it just slows the bleeding long enough for the bank to react. And then they start scrambling for cash. If reserves aren't enough, the bank borrows from other banks and money markets or directly from the central bank. This is why the central banks are called the lender of last resort. Their job is to inject cash into the system when panic threatens to wipe out otherwise functional institutions. In 2023, the U.S. Federal Reserve created the Bank Term Funding Program, allowing banks to borrow against their assets to meet withdrawals, assuming those investments would eventually mature at full value. Programs like this are designed to quickly turn frozen assets into usable cash. If a bank can borrow a massive amount of cash fast enough, it may be able to stop a run before it becomes fatal. But borrowing also carries risk. It keeps the lights on today while pushing the problems into tomorrow. Then comes the reassurance. One of the strongest anti-panic tools is insurance on deposits. In the U.S., the Federal Deposit Insurance Corporation, or FDIC, was created after the Great Depression to guarantee customer money up to a limit if a bank collapses. If people believe their deposits are protected, they're less likely to sprint for the exits. And if a bank actually fails, the insurer steps in. Sometimes another strong bank will buy the troubled one and customers barely even notice the switch. Other times, regulators seize the bank and sell off assets to pay depositors back. Deposit insurance doesn't create new money, but it does redistribute losses across the system. Banks may also try to lock money in place. Another tactic is encouraging term deposits. These are accounts that pay higher interest but can't be withdrawn until a set date. By locking up part of their liabilities, banks protect themselves from sudden cash demands. If enough money is tied into non-callable deposits, the bank can survive even while other customers withdraw. But here is the unfortunate truth. Mitigation doesn't always lead to a solution. Slowing transactions, borrowing cash, and guaranteeing deposits can stabilize a bank temporarily, but they can't undo the losses already locked into bad assets or panicked withdrawals. Eventually, the moment everyone fears arrives. At the start of a run, cash flows out fast, but after hours, sometimes even minutes, the vaults, ATMs, and digital settlement systems start to hit hard limits. People try to withdraw their money and suddenly the machines say no. There's simply no more liquid cash available to release. The hard truth is that even if the bank has assets it could sell, there's simply not enough time to convert them into cash and get it to customers' accounts. Panic drives the vast majority of people to demand their money at once, and the bank just can't keep up. But there's an even more terrifying scenario. The bank might have sold all its assets, many of them at a loss, and that means that there's literally no money left. In this case, the only way people will get their money back is if someone else, like the government or another financial institution, steps in. At this point, the bank isn't choosing to stop paying people, it is physically unable to meet the demand. The money is either trapped in future sales or loans, while customers need it to be in the present. Once liquidity is gone, the crisis stops being about fear and starts to be about math. There simply isn't enough cash to satisfy everyone asking for it all at once. And when a bank can't pay its customers, the problem quickly spreads. One institution's failure sends shocks through the entire system. When a bank finally runs out of options, the crisis stops being private and becomes public. If a bank can't meet withdrawals, it effectively fails. At that point, the Federal Reserve, regulators, and government institutions have no choice but to step in. Not to save a single bank, but to protect the entire system from collapsing with it. Historically, this is where the government takes control. During the Great Depression, after Franklin D. Roosevelt became president in 1933, he declared a nationwide bank holiday. Every bank in the country closed temporarily, so federal inspectors could check which ones were strong enough to reopen. Weak banks were reorganized, merged, or shut down completely. Roosevelt also understood that money runs on psychology as much as math, so he went straight to the public. In radio broadcasts, he told the Americans that keeping money in a bank was safer than hiding it under a mattress. He promised that reopened banks would safeguard deposits and that the government would not allow endless failures to continue. Those words mattered. They helped slow the bleeding by restoring confidence in institutions that people had completely lost faith in. But speeches weren't enough. When a modern bank collapses, the FDIC usually moves in behind the scenes. It may seize the bank after business hours, arrange a takeover by a stronger institution, and reopen the next business day under new ownership. To customers, it can look like nothing happened, even though the original bank technically died overnight. At the same time, the Federal Reserve injects liquidity into the system. It lends to healthy banks, stabilizes payment networks, and tries to make sure cash keeps moving so one failure doesn't trigger 10 more. But here is the reality. When the Fed steps in, it means the bank that held people's hard-earned cash has completely failed. After the panic, the freezes, and the government takeover, one question matters more than anything else to the regular people. Do I get my money back? When a bank run occurs and it leads to the bank failing, recovery doesn't mean everything magically returns to normal. It means sorting out who gets paid, how much they get, and who ends up taking the loss. In the United States, the most important safety net is deposit insurance, and through the FDIC, customer deposits are guaranteed up to $250,000 per depositor, per bank, per account category. That means if your bank collapses, the insured portion of your money is protected. In many cases, the process is fast. Regulators arrange for another bank to take over the failed one, and customers regain access to their insured funds almost immediately, or at least by the next business day. Checking accounts will reopen, debit cards work again, direct deposits resume, and so for millions of everyday customers, recovery feels almost instantaneous. Their money survives because it was insured. But not everyone is that lucky. Any amount above the insured limit is not guaranteed. If you had $300,000 in one account, only $250,000 is protected. The remaining $50,000 becomes a part of the failed bank's assets. You might get some of it back later after loans and property are sold, or you might get almost nothing. It depends on how bad the collapse really was. Large businesses, investors, and wealthy depositors feel the pain first. Payroll accounts, operating cash, and corporate reserves can be frozen or partially wiped out. And that's how a bank failure can ripple into layoffs, missed paychecks, or bankrupt companies even after the bank itself is gone. Recovery also takes some time. Assets have to be sold, debts have to be settled, legal processes grind forward. While insured customers move on, uninsured depositors can wait months or even years to learn how much they'll recover, if anything. So while the system protects the average person, it doesn't protect everyone equally. Bank runs don't just destroy banks. They can have lasting effects on people, businesses, and the economy. Some people walk away almost untouched. Others lose savings they spent a lifetime building. Now watch What If the US Economy Crashes? Or check out this video instead.